traders, welcome to this video. Today I want to talk about company life cycle. This model is very important for me because I only trade stocks from one phase of this life cycle here. So please have in your mind, this is just a model, and of course every company and every stock differs a little bit in the life cycle, and some of the companies and stocks also go a little bit back and forth in the life cycle. But for me it's important to have this life cycle in my mind when I look at potential trading candidates, and I want to explain why. So this is a very typical life cycle with the phases launch, growth, shakeout, maturity and decline. And it always starts on the left side. So on the left side, in this launch phase, you have a lot of private companies. Private companies are often backed by venture capital or by private capital, or they are owned by the founder. And you, as a normal retail trader, you often have no possibility to invest in those companies because they are not public offered, and you only can invest in so-called serious rounds of funding rounds, and you need a lot of cash to do that. And some very known companies are, for example, Stripe in the payment world, SpaceX, which is a company from Elon Musk, WeWork, and also Airbnb. And please have in mind, these companies are not small companies. WeWork, for example, has a valuation of about $40 billion. So this is not a small company. And also Airbnb, I think, has a valuation of about 30 billion. So very big companies, but they are private companies and owned by some venture capital funds and also by private equity funds. And in this launch phase, you often have IPOs. And the IPOs are often previous private companies, and they go to the stock exchange to get better financing options. And you must know, in this launch phase, you have always a very, very big growth. So growth in sales, and the growth is often so high you cannot compare that to growth from public traded companies. So sometimes they grow by 1,000% or similar from year over year. So this is a very early phase, and the growth is very high. The profits are often negative, and that's okay because the companies are reinvesting the profits into the sales. And of course the debt or the cash position. So the debt is often very high to refinance all the growth. And you know a lot of those companies, and those companies are in these late launch and more growth phase. So you know the names Shopify, TDOC, LVGO, FSLY, Tesla, and Zoom. You know them also from my free newsletter because I highlighted them all in the past. And this growth phase is characterized by explosive growth in sales. So for example, Shopify has a growth of 100%. TDOC, I think, is around 80. LVGO is more than 100. Tesla has not so high sales, but they're growing, and they are more into the direction of expected profits or expected earnings per sales. And Zoom, one of the best stocks in 2020, with a growth rates in sales, I think over 300%. So we are speaking here about companies which are growing very, very fast. And a lot of those companies do not have earnings at all. So this is why I personally think the profit curve here is not 100% right, and it's not ideal for all this growth stocks and growth companies. But what you can take away from that is you have a very high sales growth, and sometimes in some companies you also see very big growth in earnings per share, so very big growth in profits. Then you have a shakeout phase. I personally don't like this shakeout phase. So I think the shakeout phase is characterized by a little bit decrease in sales growth, and also a decrease a flattening profit growth. And those companies are often very, very profitable, and they're sitting on a lot of cash. And you know these names: Apple, Amazon, and Facebook. These are typical companies in the late growth phase and the beginning of the shakeout. All of those companies are still growing. So Apple is growing, Amazon is growing a little bit faster, and Facebook is also growing. But the growth from Apple is not outstanding. So I think they grew around 10 or 15% year over year. Amazon is much, much stronger, but Amazon has a little bit a different business model, so you cannot compare the revenue directly because it's often gross revenue and not the internal revenue. And Facebook, you also know them. And these companies are often characterized by not so strong sales, but they are able to optimize their profit or their earning streams very, very good. And these and the optimization of the earnings is or leads to a lot of cash, of course. And this is what they are focused on. So Apple, for example, they are very focused on delivering great earnings per shares. So they are focused on optimizing their profit streams, their earnings streams inside the company. Amazon is a little bit more focused also on growing sales and growing business opportunity. And Facebook also is at the moment more focused into profit optimization. The problem of those companies is they need new products and new services to get a little bit back on the growth, on the sales curve, back into the growth phase. So they have to innovate and they have to find new business model. And this is what makes it so difficult for an Apple and Facebook, because their focus is at the moment on profit optimization and not on innovation. So Apple is, for example, not a strong innovative company in my eyes. So they are much more on generating profit and driving their cash cows in the market. And this is a big danger for them, because the more they focus on optimization and the more they focus on getting better and higher profit margins, etc., the more they come into the maturity phase. And when they are not able to invent new products, when they are not able to find new business model to go back into the growth phase, they come sooner or later into the decline phase. And you know all those companies. IBM, for example, was a very successful company decades ago. Johnson & Johnson, PG, GM, Verizon. They are all not growing at all. So they are sometimes growing in one-digit sales growth, and they are generating profits. Often the profit growth is negative, the sales growth is negative. You can look at the numbers, for example, from IBM. And the thing is, what you must have in mind is that IBM, Johnson & Johnson, and all these companies, they all started on the left side. So they all had a launch phase, they all had a growth phase, they all had a shakeout phase. And if you go back decades and decades and look at the numbers and look at what people said about an IBM, for example, they had the same impression of IBM as we have today from Shopify or from Apple. That was a very disruptive and revolutionary company. But that was decades ago. And if you ask me, this will happen also to known brands like Apple and Facebook. Maybe not in the next 5 years, but sooner or later they will all get into maturity and decline. I also said this. These are old or dull companies, and I also spoke about that. The next old and dull companies will come from the maturity and from the shakeout phase. And I personally don't know any company which was able to steadily hold their name in the growth phase. There's almost no company in history I know. All companies are getting sooner or later to the maturity or decline, and then they get bought or they get bankrupt or whatever. Sooner or later, the demand for their services and products will decline, and they become very fat and very slow companies. I personally, and you know this if you follow me, I focus on companies and stocks in the growth phase. So I focus on companies which are early in their life cycle. And I focus on companies which are growing very, very fast. And this is why I traded Shopify, TDOC, LVGO, FSLY, etc. So I know all these stocks, and but I also know I will not hang onto them. So I will sell them. I'm a trader. I'm not an investor. So I will buy the companies in the right time, and I will sell them when an exit signal is triggered. So I don't fall in love with a stock. And I personally don't trade companies from the maturity or decline phase. I very, very rarely trade companies like Apple, Amazon, or Facebook. So because I really focus on growth stocks, I really focus on early companies early in the life cycle, and I don't trade so much IPOs, because IPOs, they have to prove themselves first. A lot of IPO stocks had a very nice marketing on their public offering. A lot of people buy the stock, and then the stock goes down for 1 or 2 years, and then after they built a great IPO base, then they had a chance to go up. But the most IPOs, or a lot of IPOs, do not come into this phase. They either get bought out by another company or they get bankrupt or something. So I personally focus more on companies which are in their business for some years, showing a good growth in sales and sometimes EPS, but I'm more focused on sales. And I want to see companies where there is a real demand for their products. This is important for me. So I repeat that again. So every company follows this principle or this model. Don't take it for 100%. So some companies are going back and forth in the cycle a little bit. Some companies are very early that they get in the shakeout or maturity phase, and sometimes companies hang a little bit longer in the growth phase. This is just a model, and this is why I don't put year numbers or something on this model, because every company has a little bit their own cycle. But important again, I don't know any company which always have been in a growth cycle. So if you know any stock, send it to me, but I don't know any company which exists for 50 or 100 years in a growth cycle. And very important for everybody who think that Apple or Facebook or Amazon is a lifetime investment, every old dull company started as a growth company. You must have that in mind if you look at investments for life. Sooner or later, every company will decrease in their sales, profits, and then, the most of them are not available anymore because they either got bought out or they are bankrupt. So have that in mind if you look at investments for 10, 20 or 30 years. It makes no sense for me, but you have to decide that for yourself. Okay, so now you understood the company life cycle in general. Now we will look at the company life cycle from a stock perspective. So, as I said, very early in the launch phase, you have a lot of these speculative stocks. So, Nikola comes in my mind, or Virgin Galactic, for example. A lot of cannabis stocks, but they are more in the growth sector. So, I personally think there are often companies getting into the IPO with an idea or something. They need a lot of capital. And then you find them in this launch phase. And the companies first have to prove themselves. So they have to survive 1 or 2 years on the stock exchange. And you have to see if there is enough demand for the stocks. And then you come into the next cycle, which is a growth cycle. And here you have strong stocks and you have strong growth and strong stock performance. So you find the most big winners in this sector. Then you have the shakeout phase, so moderate growth and often strong stock performance. So if you look at Apple, if you look at Amazon or Facebook, they performed very strongly, especially in this low QE, low interest rates environment. So if a company shows only moderate growth, it doesn't mean that the stock can go up, because those companies are very consistent earnings deliverer. Also, they deliver very consistent earnings. And this is what a lot of investors are looking for, because they think that they are safe investments, or that they can outperform when the market is declining because of their earnings. This is all okay, so I don't want to say anything about that, but this is not where I focus on. I want strong growth and I want strong stock performance. Then you have this maturity phase, so almost no growth. Stock goes sideways or slowly down. Really depends a little bit on the market situation. These stocks can hold their performance for years, so they can go sideways for 20 or 30 years. Or it can go slowly down. And then, of course, in the decline phase, you often have negative growth and the stock goes down. So if you look at that, in the maturity phase, you can, in the maturity phase, so sectors like insurance, like banking, a lot of industrials come into my mind. So cyclical stocks also, which are able not to growth, but go up and down with the global economy. And in the decline phase, you have more companies where the demand for the product is going down. So oil stocks, for example, oil stocks which went down, and some of them have also negative sales and profit rates. So these are the companies which I have in mind when I talk about maturity and decline. Now I want to, or on the next slide, I want to look with you at some stocks. But first, let me repeat this again. So every company in stock chart is different. You must have that in mind, that this is really just a general model, and it highly depends on the market situation, favorite themes. Just let me say one word to this. we are currently in a very low interest environment, so that means people are looking at stocks as a replacement for making safe money. So as a replacement, for example, for bonds or something. So if you buy an Apple or if you buy an Amazon in this low QE environment, there is a high chance that it will go up because so much money is coming into the market, and they look for big market cap companies which are able to deliver consistent earnings, and see it a little bit like an index investment or an alternative to bonds. So if you are in a different market environment where you maybe have not so good conditions regarding interest rates, those companies in this shakeout, maturity and decline phase, they can behave different. So companies which are going sideways in a very good market environment can decline when the market environment is not so good. And also, on the opposite, if you have a market environment which have a strong favorite theme, you can have companies without any profits or without any sales going to the moon. So electric vehicles or internet stocks in the 90s or something. Company with just an idea are exploding to the upside because the market is looking for risky investments, and they are looking for ideas, and the risk appetite is very good. We see that currently, as I said, with electronic vehicle stocks, for example, which are very early in their growth phase and very early in the company cycle, and they're going through the roof here. Okay, so now we come to some stocks, and I want to look at some stock charts with you, just as an example. Here are the charts of some companies. So Shopify is one of the strongest outperformers in the last 4 years. So we are looking here from June 2015 to October 2020. Shopify was really the number one here from the performance, so around 4,000% performance. And Shopify is one of the strongest grower. This is an institutional, high-quality growth stock. And if you look at other companies, Tesla, this yellow line here, for example, very successful. TDOC, this purple line, also a big outperformer. And then you can see here Amazon on this light blue line here, which had a very, very strong performance in the last years for such a mega cap company. And then you look at Apple, which only has a performance of 240% in the last 4 years. And then I also included here IBM, which has a negative performance. And if you now look at those companies, you see one thing they all have in common, and this is they are young in their life cycle, and they deliver very strong growth. And this strong growth is correlated also with strong stock performance. That's not always the case. So do not expect that every company which has great earnings or great sales growth also have a great stock performance. That's not always the case, but you find the most big winners in this growth phase. And this is why I focus on that. I try to fish in the right pond to find big monster stocks. Now let's look at such a stock like Shopify. And I want to also show you that the most stocks have the best performance very early in their life cycle. And you can see here, Shopify went live on the stock exchange, or had an IPO in 2015. They built a very nice IPO base here, and then the first run-up, the first rally appeared. And The first rally was 500%, so very strong performance. Then the next rally after the first base, and that was only 340%. So here you can see a base, and then the stock rallies 340%. And then now the current run-up is only 220%. So you can see that the older the stock gets and the more market cap the stock has, the slower is also the stock performance, which is normal because the company is getting bigger and bigger and bigger and had more and more and more attention. So more analysts are looking at the stock, try to evaluate the stock, and also more conservative investors are coming into the stock. And Shopify has a market cap of 115 billion, so it's not a small cap anymore. And and in that situation, you must always ask, how long can such a rally continue? So is that really a 200 billion? Is it a 500 billion market cap stock? I'm not sure. And this is also what other analysts are looking at. They try more and more to find the answer. How much is such a company like Shopify worth? And what is the value of such a company? I personally don't look at that. I look at a chart and I look at where is the company in the product life and in the life cycle in general. And I look at the potential for future growth when I look into their business and new business opportunities. But you must always have in mind who is also looking at the stock and who is also trading the stocks. You know, in the early phases after the IPO, there are a lot of more risk appetite people. So more people who are willing to go into the risk to own a Shopify very early in the life cycle, and they are willing to pay more and more up on owning Shopify stocks. And the older the company gets, the more and more conservative people are joining that, and they don't have such a high risk appetite, and they are not looking to pay 20% more to own a big Shopify position. And this is what you have in what you should have in mind. And the same is true if we look at Amazon. So this is a monthly chart from Amazon, and you can see a very similar pattern here. So you can see the big IPO run up here in the 90s and in the 2K bubble. So the stock went up around 5,700% after the IPO. And then the next run up was only 880, then 280, 240, 120, and so on. So with a higher market cap, with the older the company gets, the slower is also the stock performance. And I personally, I want to own such a company like Amazon. I want to own them in the first years, and I want to trade all these up moves in the first 10 years. So mostly I'm focused on companies 3 years or 5 years after their IPO. So, but in the first 10 years, the most growth is produced. And let me say another thing to Amazon. All the people who are saying that Amazon is a lifetime investment today, they didn't know that stock when it had their big run-ups here. So in that phase, Amazon was a high speculative growth stock. And the people who are owning Amazon today and talk about that as a lifetime investment, they avoid such stocks. And with such a stock selection criteria, they also miss all the big winners. But that's okay, you know. If your trading strategy is based to own companies like Amazon, like Apple, like Facebook, that's absolutely okay. But you cannot expect the same performance as we saw on Shopify from an Amazon. That's not possible. One additional thing to the stock here, you can see that the biggest performance was in the first 5 to 10 years in the Amazon stock. So in the first 10 years, the stock went up 6,350%, and then in the next 10 years, only 3,300. So, and you can see this. So the biggest performance is really in the first years. Now let's look at another stock here. This is Procter Gamble, and we also look here at the monthly chart. And that is a typical example for a company, which had their strongest up move a little bit late in their cycle. So that's what I always say. Not every company follows this model I showed you exactly. There are companies which are having their growth a little bit later. Apple, for example, is also a good example that they were able to go back in the growth cycle. Apple, for example, when they invented the iPod and when they invented the iPhone, they went back on the growth cycle and started a complete new growth business and growth cycle, and that also had a big impact on the stock. And with P&G, you can see here at the beginning they only grew moderate with 290%, and here 120%, and then they had a monster run with 1,100% here. That was also in the 90s when the stock market also exploded to the upside, and then you can see that the stock almost went sideways for around 15 years here. So of course they went up, they doubled, but they went only 100% here in 15 years, and all those up moves here getting also smaller, 100%, 180 and 90%. And this is very typical for a stock which is more in the maturity or decline phase. They go sideways for years and years and years, and then you have one very good market environment, for example now with low interest rates, and also such a big company like P&G is able to double again with the stock price. Here you can see that as I said, so in the first years only 130%, and the real biggest stock move was here in the 90s with around 850%, and then the stock goes sideways. Here in 10 years only 4%. That's a very bad performance and typical for such a stock. Okay, the takeaways, the things I want that you take away from this video. If you look at a stock and if you are interested in stock, always have this life cycle in your mind. So look at where is the stock in this life cycle. Is it on the left side at the beginning? Is it a young company? And is it also a proven IPO, or is it more a mature and slow stock, or it is even declining? So have that in mind. Again, you find the most big winners with monster stock rallies in the growth phase. So when companies are exploding in sales and sometimes also in earnings, it shows you that there is a very, very big demand for their products. And I don't speak about growth rates like 5 to 10%. No, I speak about growth rates from 30, 50, 100, 400, 1,000% year over year. And this is also reflected sooner or later in the stock charts, because people or market participants invest into companies where they expect that they will continue or even accelerate the growth in future. The third point, profits are not the most important thing for growth companies. I personally think sales growth is much more important, and also market share is much more important for a growth company, because they are investing or reinvesting the profits they generate into the growth. And this is very, very constructive for such a company. You know, companies which are showing a negative EPS today, they are sometimes profitable. They have profit margins of 80%. So for example, in the software business, but they take the profits and reinvest them into research and development and into marketing to gain higher market share and build up barriers, so make it complicated for new competitors to come into their business field. And that's okay. So I don't look so much at earnings. The older a company gets, the more earnings should be produced, because the company had so much time to optimize their profit streams. Semiconductors are a very good example for that. They only live on profit optimization. Number 4, every company will be soon or later in the maturity or decline phase. That's what I try to told you many times in this video. So have that in mind. No company is a lifetime investment. You need an exit plan for every company and every stock you buy or invest in, because sooner or later the products from the company will not be in demand anymore. The people are liking other products and buying other products from younger companies, which have more attractive products, which fitting better into the current time. So every company will sooner or later go out of business. So that's normal, and that's good, because otherwise we do not have any growth companies. Point 5, almost no company will get back into the beginning of the growth phase. That's also important. I know no company which were able to go back completely in the growth cycle. So there are turnaround companies which are able to start a complete new growth cycle or something similar, but they went through a very, very deep decrease in sales and decrease in earnings, etc. So often turnaround companies are very close to a bankrupt, and then they start to optimize their profits or invent a new product or something. These are exceptions. A lot of turnaround companies will not be able to make a successful turnaround. So have that in mind, that almost no company is getting completely back into the growth cycle. And again, older and high market cap companies have slower and smaller price rallies. I explained that some charts ago, but I want to give you another thought. And this is, if you look at a company like Apple, and Apple has a market cap of $2 trillion, you must ask yourself, will or is a company able to produce so much value in their products and so much expected growth in their products, that the company is worth $4 trillion. So always ask yourself, what could be a reason that Apple or that a company double again? So from $2 trillion to $4 trillion market cap. Yeah, I'm not sure if Apple really will reach that. So maybe if we have a big market bubble and we have low interest rates for years and years and years and years, then maybe Apple will able to do that. And also Amazon. I think Amazon has a better potential for growth than Apple. But yeah, that's just my analysis or my opinion. And but you must always have that in mind. You know, high market cap companies. The higher the market cap, the slower the stock moves, and the slower the company growth. Okay, I hope you can take away some of these thoughts into your own trading. I want to give you 2 book recommendations. So the first one is a classic book, and I think it's one of the best growth stock trading or investing books. That's from William O'Neill, so the founder of IBD. And I think the most people who are watching this video know the book. So absolute great book. You must read that. And I personally read that 1 or 2 times per year. But I want to also highlight a second book, and this is The Lifecycle Trade. It's written by Eve Bobock, Kathy Donnelly, Eric Krull, and Kurt Dahl. And you also find all the names on Twitter. You can follow them. And they also have an investing group where you can attend seminars or webinars. So very interesting. And the lifecycle trade is all about IPOs and IPO companies. So, and this is a very interesting book. So because they go through a lot of stocks and their IPO life cycle, and they look into different exit methods of IPO stocks. So very interesting. Buy that book. A true recommendation from me. If you want to understand more about IPO companies and also growth companies after they had their IPOs. Okay, so I hope that that you liked this video, and I hope that it helped you to get more insights into growth companies and trading. And if you want to follow me, you can do that on Twitter, YouTube, of course, Facebook and Instagram. And I recommend my free newsletter. So I write a free newsletter every Sunday with some trading tips and also 3 stocks from my personal watch list.